He's good. Good. Kevin, thanks. And good morning, ladies and gentlemen. Also like to welcome you to the 7th Annual Marine Money London Shipping Forum. We are again pleased to be a capital sponsor of the event, working with our friends at Marine Money. It's a great way to kick off the year. And we are kicking off the new year at a time of what is all, to us all apparent, significant uncertainty about the state of the world economy and the direction in which it's headed, and by direct implication, the state of the shipping markets going through 2016. A year ago, we were also facing considerable uncertainty on the back of a number of factors, the most notable of which was the OPEC decision in the fall of 2014 to maintain current production levels in the face of clear evidence of oversupply. This sent oil prices plunging and global financial markets into shock. But I think the picture at the beginning of 2016 is a lot more challenging than it was 12 months ago. Mainly, oil prices have remained low and more recently have resumed their fall to levels not seen since the early years of the last decade. Hundreds of billions of dollars planned investments in new E&P activity have been put on hold. Devastation in the oil service sector has clearly begun to evidence itself and will continue to worsen. The energy high-yield sector has been hit hard, and the holy grail, the sustainability of oil majors' dividends, is increasingly being questioned. Slowdown of growth in a transitioning Chinese economy is becoming increasingly apparent, and combined with growing uncertainty about the government's ability to effectively manage its currency and domestic equity markets. These factors, which I think were also in evidence in Apple's earnings announcement yesterday, have accelerated a downward trend in the commodity sector, as well as the emerging market economies. Interest rates in the U.S. have begun their rise, although how much they will continue to rise during 2016, I think is an open question. And more generally, the OECD economies struggled to create real demand in there, despite concerted central bank efforts. So these factors and others have created a real wall of worry for investors, and clearly they're struggling in the first 3 months of the new year, first 3 weeks of the new year, excuse me. And this wall of worry has had a pretty devastating effect on the shipping sector. The valuations of the publicly listed companies have all been crushed. It is puzzling and I'm sure very frustrating for company managements and principals to witness the pummeling of their share prices when in many sectors the physical markets, freight rates, remain quite robust. But shipping, particularly on the wet side, is for the time being directly correlated in investors' minds with the energy sector, which with the dramatic fall in prices has created huge losses for investors, both in debt and equity. And energy is a big percentage of investors' portfolios, much bigger than shipping. So investors have become very defensive. Reducing energy and energy-related exposures has become a priority, and any consideration of incremental investments, they're either not available at all or at relatively expensive terms. And I'm not confident that that picture changes anytime soon. The headline of the forum is Riding Choppy Seas. I think that's a bit understated. I think we're riding in a tsunami, and I think things will get rougher before they get any better. But I want to also be clear that not all shipping companies are in the same boat. The tsunami is mainly impacting the publicly listed companies, or public or private if you're operating in the dry bulk sector. Your typical private European or Asian ship owner with diversified activities, crude, dry, maybe some product, is probably doing quite okay. Profits from one sector are offsetting losses in another. Nevertheless, I believe the negative development in the public valuations will have a significant influence on how the shipping markets and the ownership landscape will change or develop in 2016. Why should a company like Euronav, enjoying a market-leading position and robust freight market conditions, see its share price fall by over 40% in the last 3+ months? We all know some of the public dry bulk companies are trading under $1 a share, and the shipping MLP stocks have been devastated. It does beg the question of whether or not a shipping company, it's worthwhile to be public. CMB of Belgium recently gave its answer to that question by taking itself private. For me, it's not a question of one model being right and the other model wrong. Public market ownership is an absolutely viable model for shipping and will be a continuing trend. We get more questions these days about whether investors will return to the sector, whether new investors can be attracted into the sector. Our belief is the answers to both of those questions is yes. Investors have made money in shipping and they will continue to support it. And we believe the pool of investors will continue to grow. Every point in the cycle offers opportunities. However, factors such as scale and market capitalization, liquidity in the share, and principal owner and management track record, and alignment of interests with the other shareholders are increasingly important, I would say absolutely critical for attracting long-term investors and obtaining attractive valuations through the cycle. And in terms of new IPOs, they will be absolute requirements. For those companies that have chosen to list, it is a long-term strategic decision to strengthen and diversify their access to growth capital. And I stress long-term because shorter-term temporary market dislocations, such as that which we experience today, will always exist. Private ownership, of course, is also a very viable model, and indeed, with a few exceptions, many of the largest, and one could argue most successful and most diversified non-government controlled shipping companies in the world today are privately owned. These groups continue to have very good access to traditional bank finance on very competitive terms. But it is challenging to build scale and maintain diversity as a private owner. The equity is your own, or you partner with other sources of private equity. And we obviously have seen a lot of that type of activity over the past 4 or 5 years. Shipping, as we know, is capital intensive, and scale is increasingly important for commercial reasons, and as well to spread an increasing cost base over a larger number of units. I think it's noteworthy that several of the leading private ship-owning groups do have public vehicles for parts of their business, and others have partnered with other private capital sources to expand certain parts of their business. So even the strongest private owners have availed themselves of third-party capital, public or private, and I would expect this trend to continue as well. All this being said, with where the public markets are valuing the sector currently, I believe the well-capitalized and well-banked traditional ship owners, private owners, are better positioned to take advantage of market opportunities which may arise in 2016, and I do think they will be plentiful. And that's a good place to transition into one or two core themes that I see being front and center in the coming year. First, you want to raise cash? Call your friendly shipbroker, not your investment banker. Current public valuations preclude IPO activity. Those contemplating to list their shipping activities need to see the existing comps trading at much healthier levels before this is a viable option. At the same time, the existing public companies won't raise common equity at current prices. It's way too dilutive for most of them. And so that effectively eliminates raising equity for growth and takes them out of any meaningful role in sale and purchase or consolidation activity. So the least expensive way to raise capital today is by selling assets, traditional S&P. And for the reasons we've talked about a bit, the buyer universe is largely limited to the traditional private owners. And that is what we've been seeing, particularly on the dry bulk side, where groups such as Angelicousis, Zodiac, and Theodore, among others, have been picking up historically cheap Cape-size new buildings sold by several of the public companies. These owners have cash, they have ready access to traditional bank financing, they can move quickly, they are a relatively chosen few. So advantage private ship owner. A second theme, at least in the short term, capital for shipping is becoming increasingly scarce and expensive across the capital structure. The current public valuations are what they are, in most cases well below NAV. The shipping MLPs face the same situation, significantly reduced valuations resulting in a cost of capital based on current yields, which is not competitive and highly dilutive to existing owners. So common equity is very challenging, to say the least, for the time being. Hybrid equity capital, preferreds, redeemable, perpetual, straight, convertible. This is potentially available, but the providers of this capital have a strong preference for companies with a high degree of contract coverage. Read the MLPs. And it's not cheap. The coupon will be in the high single digits, typically with a 9 handle at a minimum, and will have potentially dilutive elements included. The high-yield bond market is closed for shipping, C Corp or MLP, full stop. 2015 has been a cruel year for the high-yield market in general, as I mentioned, driven in large measure by the negative developments in the energy and energy-related sectors. Spreads have seen increases of 200 to 250 bips at a minimum across the range of credit ratings, and the energy high-yield indexes in the U.S. today are currently yielding around 20%. And lastly, I think bank debt will become increasingly expensive and scarce. The core banks focused on shipping, and there are relatively few of them, continue their flight to quality, continue to focus on a smaller and typically the same group of clients. Increasing capital requirements is a big driver here. Shipping is a relatively high-risk sector, meaning less balance sheet will be available going forward and on increasingly expensive terms. Last year I asked if consolidation would be a more prevalent theme in 2015. That didn't really pan out in the traditional sense. One example that did occur was Apollo selling its crude oil tanker fleet to TK. But more of the activity was in traditional S&P, and I think that will be a continuing trend. I do think the current environment will lead to more consolidation activity. The current public valuations may make it easier for public companies to merge via share-for-share exchanges. The continued distressed outlook in the dry bulk sector may compel combinations. It will certainly compel further S&P activity. But I think the bigger driver here will be the private equity firms who have had to wait yet another year for an exit. The vehicles they participate in are too small to go public in their own right, and they may well be motivated to take profits if there are profits to be taken. So I think private equity will increasingly be looking for exit solutions. The alternatives are, in my view, to merge with other entities in order to create more scale and make themselves more attractive for a public market which will eventually open to new listings. Or they just call their favorite shipbroker and sell. So briefly, the outlook for shipping in the near term is very closely correlated with the energy complex and the fallout there, as well as the concerns about slowdown in growth in China. I think at a minimum we need to see some clear signs of stabilization in these two factors before the picture will begin to change. I thank you for your attention and hope you'll enjoy the conference.